What's the issue? The Mets and Yankees are in the playoffs and the Red Sox aren't. But this is the Issues Watch podcast. Hello, and welcome to the Issues Watch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm the partner in charge of accounting and auditing at Sobel Co. And back with me today, field reporter, although remotely, is Frank Boutillette, an emeritus partner at Witham and my co-presenter for many A&A presentations and the Society's Law and Ethics webinars. Welcome back, Frank.
Thank you for having me, Brad.
Remember, this episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are our own and not necessarily those of NJCPA, Sobel Co, or Witham. Okay, Frank, we don't have a lot of heavy topics as to different areas. We won't mention ESG, although I just did. But some of the areas are really esoteric, but I want people to really kind of focus on these. The first one is stock-based compensation. Generally, the accounting treatment for stock-based compensation, we're not going to go into a whole, FASB 123 discussion here, but generally the expense recognition for stock-based compensation or equity-based compensation is as the grant vests over the time, and also taking into consideration forfeitures. The interesting thing, though, is what's the tax impact on these? I'm going to let it hang there for a little bit, Frank, and let Nicole think we're talking about tax stuff and we're stealing her limelight, because she gets all upset about that. Especially now a Witham person's doing it too, and she's like, "Why are you people talking about tax?" Anyway, don't everybody from the side, don't go back and tell her I did that. But anyway, the big issue is the tax treatment. Now, we're not talking about the tax itself, but the accounting for taxes and tax provisions and tax considerations. So generally, and I wish we did have Nicole here. I love her. She's a great presenter. She could go on for hours on this. Generally, there's two treatments as it relates to the tax treatments as it relates to the stock-based compensation. And it depends on the grant that's issued. If it's an ISO or non-qualified options. ISOs, generally, there's no tax deduction. And I'm not going to get into the personal taxes here heavily, but there's generally no tax deduction, which makes the expense that you recognize a permanent difference, because the company is never going to get a deduction for the ISOs. Now, as it relates to non-qualified options, there's a partial deduction. Now, when the person exercises those options, they have to pick up into income the differential between the exercise price and the fair value at that time. And they pick it up and it's on their W-2, and accordingly, the company then gets a deduction for that amount. That might not be the amount that you recognize the expense. So the FASB came out with ASU 2016-9, and I recommend you look it up. It came out a while ago, but they're still talking about this because they feel that people are not addressing this properly, because some of the non-qualified is permanent difference and some of it is treated as temporary difference. Now, you don't know what the temporary difference is going to be because you don't know what the fair value is going to be at the time of exercise. So it's an interesting concept. If you deal with stock-based compensation, I strongly recommend that you look into this. The FASB saying that people are still not getting it right. I like ISOs because it just makes it a permanent difference and we just move on, although the company doesn't get a deduction. So that's it on stock-based compensation. Frank, what do you got for us?
Well, before I go there, Brad, one thing I want to say on that, Audit Analytics reported that accounting for income taxes is in the top 5 restatements in the last 10 years. So if it's so complex that firms are constantly restating their financial statements, why don't they simplify it? Just a thought,
It's a great question. And one thing I know, because I do a lot of tax provisions, I don't know if you've seen this, Frank. The one thing I see, what I do is I round a lot, okay? People try and get exact, and you're never going to get close. It's an estimate.
Right.
But to Frank's comment is you shouldn't be restating. So it is a complex area. And you're right, Frank. Why don't they simplify this a little bit more?
By the way, I round up my 1040, Brad. So I don't know if that's allowed. So, so I'm going to talk about Libor. So ASU 2018-16. So that's 2018 is when this came out, 4 years ago. What's happened is they're moving away from Libor and moving to the secured overnight financing rate. And it was supposed to go into effect in 22. The banks are now no longer, as of January 1st, 22, not issuing loans that are that are using Libor as the rate. And this is mostly seen in swaps. So the FASB is considering giving a 2-year extension so companies have a chance to understand this and what the impact is and the accounting treatment. I think that this proposal, it's good to delay it because I think there's a lot of confusion on how to account for it. There is some complications where you have to do a determination whether switching to the SOFR becomes a new loan altogether, or whether you just have a modification. So that there are a lot of the big four, I think 3 of the big 4 said, let's postpone this for another 2 years so we really understand this. So the question is, is your company ready? Now, got to think about that. And here's my quick summary of Libor, and this is Frank Boutillette only, not even Brad. This is my position. I had a client years ago that did a swap, and the fair value of the swap was a liability, so he was underwater. We had to record the liability on the books, and the client said it was a $3 million loan with a $1.5 million liability. He said, "What is this liability, though?" I said, "Well, if you decide to pay this off, you got to pay an extra $1.5 million." He goes, "Why would I ever do that? I'm never going to pay it off sooner. If I got to pay more, I'll just hold it to the end." So I said, "I like that. So why would I put this on the financial statements? It makes no sense at all." But I digress. I shouldn't say that. You have to follow GAAP. Let's move on, Brett.
And prepayment penalties, normal prepayment penalties aren't on the financial statements unless you intend to prepay the debt.
Absolutely.
I never understood that. All right. So far, we're not doing anything with SOFR. That's what you said to me. All right. That's what we got out of it.
So far, no SOFR.
Right. Exactly. I kill me. I'm like Alf. All right. So let's talk about leases. I don't know. I can't go an episode without talking about ESG or leases, it seems. So the other day, the FASB met and they came up with tentative board decision on related party leases. Now, don't get excited. John Malaj in my office got all excited thinking 842 doesn't apply. They didn't say that, unfortunately. But they came up with related party leases, talking about non-documented leases and particularly about leasehold improvements. So I'm going to focus on the leasehold improvements here. I'm not going to talk about the non-documented. So the board decided to amend 842. I don't know how they came out with this thing in 2008. They started and finally came out in 16, and they're amending it still. For all entities with leases between entities under common control to specify that how the leasehold should account for leasehold improvements as follows. And I apologize for reading, but I want to make sure I read exactly what they said. This is from the email that I got from the FASB, not from me personally. It's a blast they did. Amortize leasehold improvements over the economic life of the improvements as long as the lessee continues to use the underlying asset. If the lessor, that's the related party, if the lessor obtained the underlying asset through a lease, so the lessor leased it and then leased it to a related party is what they're saying, through a lease with an entity not under common control, the economic life of that leasehold should be amortized over that lease term. Sounds very logical. Accounting for the remaining leasehold improvements, what they're saying here in this paragraph, first paragraph, is that if you have a leasehold with a related party, you can do it over the economic life and not the lease term, which is big. A lot of our clients, a lot of the private companies, it's an operating company that has they rent the building for 10 years and they do leasehold improvements, and we turn to the client and say, you have to amortize it over 10 years. That's the life of the lease. And they say, no, it's 39 years. 39 years. Why? Because that's tax. And that's what we want to do. So now you can go and use it over the economic life. May not be 39 years, but you can do it now over the economic life. Account for any remaining leasehold improvements, as if you leave the property, as a transfer between entities under common control if and when the lessee ceases to use the underlying asset. So I thought that was really interesting that they came up with it. Frank, I don't know how it took to 842 for them to come up with something like this. Why didn't the previous leases, FAS 13, whatever you want to call it, how come they never discussed this? The board decided that a lessee should disclose this information about the leases, which the economic life of the leasehold improvement is longer than the lease term. Disclosure, disclosure, disclosure. And still, there's no comment on consolidated and consolidating financial statements. We've had a big discussion at the A&A interest group about this. My feeling is that the consolidating you have to adopt 842, even if it's related party leases, and then eliminate to get to the consolidated. I have a whole thought on this. I just talked about it at the Passaic chapter. And if you ever want to hear my diatribe on it, I'll bring my soapbox over to your office and we can talk.
Cool.
That's all I have for the FASB. Frank, you have any other area?
Just a real quick on the SEC, because, we got to talk about SEC every once in a while, and ESG, all the initials we talk about. So the SEC is setting up two new offices because, as you know, crypto and life sciences are booming right now. So they are setting up two offices, an office of crypto assets and an office of industrial applications and services, to join the other 7 offices that they have. And these offices are just going to do a deep dive into crypto and life sciences, the accounting treatment, how companies are reporting these, to kind of make it more general across all of the entities. So that's new, coming out. Not sure when exactly they'll put those in place, but be on the lookout. So if you do those 2 industries, crypto and life sciences, know that the SEC will be scrutinizing the financial statements.
Yeah, I guess new offices means bigger focus on these areas. And
yeah,
we all know that they need to be focusing on crypto, but the life science one surprises me.
Me too.
All right, so those are our topics. And in closing, I'd like to remind you about some upcoming NJCPA events, some in person and some virtual. The Society's Accounting and Auditing Conference is on October 18th. It's a 5-hour virtual event. I know 2 really good speakers that'll be there. The Middlesex Somerset chapter has a 4-hour in-person A&A update on October 18th in East Brunswick. The Southwest chapter has an in-person A&A update on October 27th in Cinnaminson. And there are 2 different 4-hour webcasts on leases, one on November 2nd and one on November 3rd, my birthday. So there's a lot to choose from. Register for these events and more at njcpa.org/events. And as usual, be sure to join the NJCPA Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Frank, thank you very much for joining me. It always makes it much easier when you're here and working with me on this, and much more fun when you're with me.
Thank you, Brad. Glad to be here. Thank you.
And thank you, everybody, for watching and listening. Tune in again.